influencing the accountant's involvement in the strategic management process. First is accountant lead factor, which is interpersonal, skill set, technical and desire. Second is organizational factor, which is position in organization, culture, trustee credibility and relationship. Third is practicalities, which is resources capacity, information system and provision of information. The factor that same with accountant factor and organizational factor is business knowledge and ability to add value. The factor ability to add value is the same factor with the three factor, which is accountant factor, organizational factor and practicalities.
Role of accountants. For business partner, 7 of the participants state without prompting that they actively undertake and use the term business partnering within the organization. 2 of these participants had been in a position to instigate the process themselves by virtue of being recruited with a remit to improve the management information within the organization. There was an implication that the culture of the organization that embraced business partnering was more team-led than a function-led. Although no participant explicitly stated this, but their description was referred to teams rather than functional names. In this organization, the accounting department was structured so that it facilitated contact between members of the accounting team and managers. For provision of information, all participants were asked to describe the routine management information provided, and this invariably include the monthly board pack, which in the majority of case contain non-financial information as well as financial, although none of the participants had adopted the formal technique of the balance scorecard. Kaplan and Norton 1992. All organizations will utilize a budget or plan with which to compare actual performance, and the majority fed this back into a reforecast or updated estimate of end of the year performance. Said participants described the use of rolling forecast. The use of variance analysis and exception reporting will also highlight in relation to the reporting of performance against plan. Those participants that described the use of rolling forecast indicated that the monthly monitoring activity fed back into the strategic management process, as adjustment to strategy could be made based on a review of performance and evaluation of the potential consequence of changes in the business environment.
Support strategic decision. The strategic decision described by participants can be grouped into 4 main areas, which is pricing, business or market development, product development, and merger and acquisition activity. Within the area of pricing and understanding of the cost behavior in terms of variable and fixed costs was significant, but the pricing method discussed fell into 2 main methods, which is market pricing and cost plus. There was a strong emphasis placed on margin, and in one instance, the margin achieved per market sector served were monitored rather than individual product line. The analysis and allocation using techniques such as activity-based costing. In fact, there was only one instance of an ABC exercise being discussed in detail, which was undertaken within a manufacturing organization as a one-off exercise for the purpose of checking cost and pricing. The main reason for not undertaking ABC was the resources required and volume of information needed to undertake a meaningful analysis. In terms of business or market development, the significance placed on the input provided from an accounting perspective was more for assurance purpose than a make or break situation for the decision. The degree of uncertainty was recognized. In terms of mergers and acquisition, the accounting input was limited to what could be described as the due diligence process. The strategic and cultural fit and possibility of cross-selling and potential cannibalization of existing business were considered. There was no significant attempt to evaluate the financial impact of this potential strategic outcome. This was partly due to the uncertainties surrounding the findings of any financial analysis that could be produced, which several of the interviewees felt could be potentially more damaging than not knowing.
Next, we go to key techniques. The techniques described by the participant included target costing, net present value, cost-benefit analysis, benchmarking, and customer profitability. The use of non-financial information and performance monitoring was also discussed. The discussion also revealed that the majority of interviewers emphasized the importance of monetary margins. Very few of techniques classified by previous surveys undertaken to determine the use of strategic management accounting were considered by participants. You can see the table 2. There were also some skepticism about the more sophisticated techniques when raised with the interviewees as to their value, mainly due to the availability of accurate information. However, it is important to note that the list in Table 2 was not shown to participants, but the technique which might have been appropriate to the business were introduced into discussion by the interviewers. The most popular technique used was customer profitability analysis, with all participants either describing the extent to which they utilize customer analysis, or in the case of two participants, in expressing how they intend to develop the analysis in the future. The extent to which the technique is used range from keeping an eye on the profitability of market sectors to accounts and other customers, with business managers actively targeting particular customers or customer groups. One of the consultants mentioned the use of ABC to help allocate customer-driven indirect costs. All other participants using the techniques analysis up to margin or contribution only. Next, the use of benchmarking was mentioned in the context of competitor analysis and the use of industry and the best-in-class benchmarking. The extent to which competitor analysis was undertaken is minimal, with most participants indicating that they monitor the sector, knew who the competitors were, and understood their own position within the market. The majority of interviewers note that difficulty of obtaining accurate information about their competitors to undertake any extensive analysis. Attention also was paid to competitor pricing and product or service offering, but no attempt was made to analyze a competitor's strategies. In terms of performance measurement, only one participant utilized what could be described as a moving towards a balanced scorecard approach. This was facilitated by the introduction of an enterprise resource planning, which is our ERP system.
Strategic management accounting. Discussion around the meaning of the term strategic management accounting as a sub-concept of management accounting revealed an anonymously that participants did not subscribe to a view that such a separate concept exists. This agrees with the finding of Lanfear-Smith 2008 and Nixon 2011 that the term is not used within the lexicon of accounting in practice. The discussion returned to the notion of business partnering in that management return and management accounting is about supporting managers, and that placing a definition on the specific activity or technique is counterproductive as it highlights the activity of accounting when the focus should be on supporting the business. Three participants felt that there was no clear definition of strategy and that put the word strategy into a term to describe accounting was problematic.
As for conclusion, there are three factors were identified that could influence the degree to which accountants were involved in the strategic management process. These were organizational influences, accountant-led influences, and practicalities. There were recognition that even though there may be a desire by the accountant to become involved, the organizational influences and practicalities may limit the degree to which this is possible. Even then, the skill set of the accountant is important in that it is not just accounting skills that are required but the wider skill set, including business acumen, interpersonal skills, and the ability to build a relationship with senior management that enables the accountant to add value to the process. The main areas to which management accounting information and techniques are utilized to support strategic decision making is in the information gathering and analysis stage, albeit mostly in connection with current performance, strategy formulation, and the monitoring and evaluation stage, as it is shown in figure. This was mostly via the provision of performance information, reforecasting, and investment appraisal. The use of simple reforecasting techniques was also seen as contributing to the strategic management process in that it helped to shape future strategy or indicate the need for strategic action. The implication of strategic decision on the reforecasting was also seen as a contributing factor to strategic development. There was no suggestion that accountants develop or initiate the strategy, but there was an emphasis on working with other senior management within the organization to assist in the analysis, formulation, and monitoring and evaluation of strategy. However, in those organizations where the concept of business partnering was not paramount, the focus was still on the monitoring and evaluation aspect. The most common aspect of strategic decision-making where management accounting is seen to make a significant contribution is in the validation of strategic decisions. It was the assurance that the strategic decision is viable rather than a make or break input. Typical strategic decisions involve pricing, business or market development, new product development, and mergers and acquisitions. Techniques such as benchmarking, customer profitability analysis, and investment appraisal techniques were most commonly used. Access to information and resource required were a key determinant in the use of technique with the basic techniques being seen as adding the most value. There was some skepticism about the value of some of the more sophisticated techniques due to the uncertainties around the accuracy of information available. The term strategic management accounting was not looked upon favorably by the participant as being a sub-concept of management accounting. It was felt that using a term such as strategic was a problematic due to its subjective nature. The closest definition that incorporated what accountants do was encapsulated in the term business partnering.